Okay, so now we'll start the survey proper. So we'll start the webinar proper today. Today's webinar will be focusing on results from last week and some of our trading notes that we have now for the US stocks. First up, SATS. So SATS announced their results last week. We'll go through the results first and talk about what's going on with SATS. For SATS, we have maintained our neutral rating. Target price is now 473. Last close was 497, but I think today has come down a bit already. So first thing first, we talk about their two business segments, food solutions and gateway services. So you can see it's roughly flat. One is down 1.8%, one is up 2.2%. Overall net effect revenue was flat year on year, 441 for the third quarter. So for food solutions, the main reason for the 1.8% lower year on year is there was a timing difference for the recognition of revenue for one of their large scale non-aviation catering event. That event was held in a 3Q16, which was last year, the same quarter, and then for FY17 that event was held in 2Q17, so that's why there's an absence of it in 3Q17. For gateway services, they saw more activity for gateway services due to higher cargo volumes because of the bankruptcy of Hanjin Shipping, and it pushed some of the sea freight to air freight. EBIT was up 7.9% year on year on the back of 1.3% lower expenses. This resulted in a 1.1% percentage point margin expansion to 15.1%. Within their associates and JVs, they have both gateway services and food solutions JVs as well. The gateway services JV also experienced higher volumes for the same reason above as at the revenue line. So their gateway JVs had a 9.9% higher year-on-year contribution as a result of the bankruptcy of Hanjin Shipping and the sea freight being pushed to air freight. To sum up, PATMI was 7.4% higher due to the reasons above. So we'll now go on to talk a bit about what has happened in the quarter and what's the outlook and what's the business strategy for the future. First thing first, aviation to remain under pressure, but building networks to enhance connectivity. So the CEO for SATS already has said during the results briefing that airlines continue to be under pressure and that will result in it being difficult for SATS to raise prices. So the thing that the services that SATS provides to airlines is the in-flight catering and the ground handling. So going on to the other aspect of their business, which is TFK Corp. This is the food catering business in Tokyo. During the quarter, there was lower volume, but there was some positive offset from the appreciation of the yen against Sing dollar. So this helped in the revenue side. Some past things, what they've done for building network within Asia, they have done 2 acquisitions last year, which was Brahim's Catering in Malaysia and Macro Asia Catering in the Philippines. Now, in order to build up their network, they are going on to the next continent, the next adjacent continent, which is the Middle East. So what they need to do to build up a network is to find a base area where there's a lot of connectivity from that base. So the 2 bases that they're setting up is in Muscat, Oman and Daman, Saudi Arabia. So for these 2 JVs, they're both cargo handling JVs. From the one in Muscat, Oman, what they did was they had acquired a stake in cargo handling business that's already operational. So this was a acquisition and joint venture, and it's already immediately contributing to the group. Whereas for the joint venture in Saudi Arabia, this is a fresh startup, so it's not contributing at all yet. Okay, so in light of the pressures in the aviation sector, SATS has also been actively diversifying to non-aviation. In fact, this isn't a new thing. All along, SATS started off as an aviation food caterer, but then it has already diversified its food to do institutional catering, such as the food solution services at the SAF camps. So this diversifying outside of aviation to the non-aviation sector is not new. The two recent developments in this area is their joint venture with DFAS. So DFAS is the in-flight duty-free sales business. So what they're doing is they're partnering with DFAS to do the delivery of the duty-free that has been purchased in flight. So for this JV, it was already an existing business and is contributing to the group now already. The feedback that is profitable and they're actually expanding in Singapore. For the other JV, the SATS E-High Carry JV is actually a JV with Wilmar in China to supply food at the institutional catering as well. So they have already completed the construction of the factory outside of Shanghai and it's actually ready to prepare food and is now undergoing hygiene and customer audits. So the group expects it to start catering and having revenue meals by the end of this FY, which is March 2017. Reinvesting in capex to harness technology, improve productivity, and drive growth. So you will notice that SATS has been going on a capex spree. They are upgrading their equipment, they are buying machinery. So one thing is this SATS Air Freight Terminal 1, they've actually upgraded it to handle e-commerce and aerial sortation for SingPost. SingPost used to have an air freight terminal at Changi Airport as well, but they did not extend the lease there because they were going to partner with SATS and let SATS handle their airmail for them. So now this SATS has already invested capex in this terminal to convert it. The facility is able to handle 4 times more mail than before, but with less manpower. So we're talking about technology, productivity, and growth. So the ultimate goal is to make use of machines and to improve productivity by using more machines and then keeping headcount flat. Okay, we move on to Comfort DelGro, which announced their full year FY16 results last Friday evening. So we have downgraded from buy to accumulate, and our target price has been our new target price is slightly higher at 294. It was 292, and we are now forecasting a dividend of 10.4 cents for FY17. The last close was 251. So for this fourth quarter results, they declared a final dividend of 6.05 cents, which is higher than last year's 5 cents. On a full year basis, the FY16 dividend is 10.3 cents. This represents a 70% payout, which is higher than FY15's 9 cents and 64% payout. One change that was made during this quarter for Comfort DelGro and their subsidiary SBS Transit is that in the past they used to separate out their reporting disclosure for bus and taxi, but in this quarter they have lumped taxi and bus together under public transport services. So for SBS Transit, that will be all the domestic bus and the rail in Singapore, which is a downtown line and northeast line. So likewise for Comfort DelGro, they have also lumped their global taxi business together with the rail business. So their global taxi business spans mainly Singapore, Australia, Singapore, UK, China, and Australia. Um, so you look here, we'll talk about their group revenue first, and then I'll go into detail on the individual contributions. But right here, group revenue was down 1.3% year on year. Actually, this was mainly due to unfavorable foreign currency translation. Their actual revenue grew by 72.4 million. So this shows that actually there has been revenue growth and the business actually is getting better. So now we'll go into a bit more detail on the breakdown. We'll just focus on the two largest segments, which is public transport services here and taxi. So for public transport services, it was down 1.1% year-on-year revenue, but this was mainly due to, again, unfavorable foreign currency translation. The revenue for public transport service actually grew by $75.4 million in local currency terms. For taxi-wise, there was an increase. Actually, the increase was 35.2 million, but this was partially eroded by unfavorable foreign currency translation as well, just like the public transport services. For taxi, this was due to the weaker pound, renminbi, Australian dollar, and the Vietnamese dong. Okay, now for the EBIT. So EBIT was higher by 2.6%. The thing to take note about foreign currency translation is that while it affects on the revenue side, it also affects on the cost. So if you have a foreign currency loss on revenue, you actually make a foreign currency gain on operating expenses, because expenses will be in that same currency that you collect the revenue in. So because of that, there was a 48 million increase in operating expenses, but this was offset by the favorable currency translation. So in local currency terms, EBIT actually increased by 5.3%, but in Singapore dollars, the EBIT was 2.6%. PATMI at the group level was higher year on year by 5%. Due to the higher EBIT and the lower financing costs. This resulted in a better net margin of 7.8% in FY16 compared to 7.3% in FY15. Now we'll talk about the three main business segments for Comfort DelGro. First is bus. So in short, the bus generally will be benefiting from the new government bus contracting model in Singapore. This is through their subsidiary SBS Transit. So for FY17, Comfort DelGro will be accruing a full year contribution under the bus contracting model as compared to the FY16 4-month contribution, where this bus contracting model started in 1st of September 2016. One thing to note though is that although this bus contracting model has become profitable for them, but their market share has shrunk a little bit because of the two packets that were won by the foreign players. For their bus service in Australia, management is expecting to recognize more revenue in 2017 than 2016 because the local government there intends to increase more services for buses. For the UK side, management is expecting lower revenue mainly due to foreign exchange weaknesses and because of cutbacks in services. Taxi-wise, the Singapore taxi continues to face pressure from rail and the private hire cars. That's PHC. PHC stands for private hire cars. So overall, their global FY17 taxi was lower. But this was due to FX, as I showed here. For Singapore FY16, their taxi idle rate was 1.6%. This seems to suggest that the idle rate in fourth quarter of the year was a lot higher because the idle rate in the first 9 months was only 1%. So fourth quarter should have been higher in order to have an average 1.6% for the whole year. Something to note too is that there was lower volume of diesel sold to the taxi hirers. So this was due to two reasons, but the main reason is because of the fleet replacement to the I-40 from the Sonata taxis. The I-40 is more fuel efficient than the Sonata. So this was the main contributor to the lower diesel volume sold. But of course, partial contribution also came from the fact that there were fewer number of trips done as well by the taxi hirers during the year. Management outlined their strategy for the Singapore taxi business. First thing first is they are going to slow down the fleet renewal. They will try to extend the lifespan of the taxi. So by extending the lifespan, as a taxi gets older, the rental rate will come down as well. So their aim is to keep rental low and to retain the hirers so that to maintain that the fleet is being rented out. And next for rail, so we talked about rail. Rail during the quarter or for the year was still dragged down by downtown line. Downtown line, full line is not operational yet. Only we are only working on downtown line 2, but startup costs have already been incurred for downtown line stage 3, which is not revenue producing yet. Startup and hiring costs are expected to taper off already because they've done the bulk of their hiring for the staff for downtown line 3. Why we say that it will be the next source of earnings growth once normalized is based on LTA's projection, the full downtown line is expected to have a ridership of 500,000 daily passenger trips. That's more than double of the current 220,000 passenger trips that's on downtown line stage 2 already. As I said in this bullet point about pressure from rail, so we also see that as the rail network expands, this would actually put pressure on the taxi business as the rail business is in direct competition for passengers. Potential positive catalyst for the rail segment will come from the Thomson East Coast Line tender, which is expected to be, the tender is expected to be called sometime by the end of the first quarter of this year, and the results should be known by the end of this year. Now we move on to 800 Super, which also announced their results last Friday. We have upgraded to buy, and we have also increased our target price to 142. Last close is 109. Revenue was up 3.2% for the quarter, from new projects and a renewal of projects. Operating expense was 2.4% lower, and this resulted in higher EBIT of 85% higher. And the effects of this flowed to the net income line, where net income was 111% higher year on year. Net margin for the quarter was higher also, 9.2% from 4.5% a year ago. Now we talk about margin expansion. Margin expansion was due to cost control, and we believe that the margin is sustainable going forward. So the two biggest cost components for the business is staff costs and purchases of supplies and disposal charges. So we understand that staff costs in this quarter was lower year on year, mainly because of lower headcount. What the company is doing is making use of equipment and machinery and getting the staff to be more productive, and that's why they could lower headcount year on year. Lower purchases of supplies and disposal charges year on year was because last year there was one-off startup costs for a project. So this current expense for this quarter is what we expect to see around this level going forward quarter on quarter for the next few quarters. So as such, these are the reasons why we think that the costs will remain around this level, and that's why margins will be sustainable. Now we talk about their contract for the treatment and disposal of sludge, which was announced last year, and it was awarded by the Public Utilities Board. So we want to make it clear that this contract is not contributing to the group yet. It was announced last year, and in that announcement it was said that the contract starts in November, but actually nothing has started yet. They still need to construct the facility, and management has guided that construction should commence sometime in the second quarter of 2018, calendar year 2018. Okay, one point, I think the most exciting piece of news is actually they have introduced a maiden interim dividend of 1 cent per share. This is the first time that they're having an interim dividend. They have all along given only final dividend at the end of the FY. So we have kept our payout ratio forecast intact. We have kept it at about 30% of earnings for this year. So what may happen because of the interim dividend? We think that firstly, obviously, there could be better interest in the stock now that it will pay interim dividend, and that will improve the trading liquidity for the stock as well. Our one major change that we had in our report also is that we have changed the valuation method for 800 Super. Please go and read the report for the details on the rationale for the change and the assumptions in the model. So, but our target price is based on the discounted cash flow, and the target price of 142 gives an implied P of 15.4 times of FY17 earnings. The current STI Straits Times Index implied P is 14.4 times. Okay, we'll move on to the next presentation.
Hi, good morning everyone. It's Peter here. It's a quick update from me on GLP. So GLP reported their results last week, and results came in largely in line with what we think. So revenue was up 17%, up to $232.5 million, and it was mainly driven by higher completion of, driven by completion and stabilization of development projects in China. So at the same time, there was also new revenue contribution for financial services in China, which is a new business segment that the company has just introduced. So, and finally, there was actually higher fund management fee income. So we are talking more about the fund management platform that GLP is doing. So the EBIT level, excluding revaluations of the properties that they own, it was down 26% year on year to $154.7 million, and this was mainly due to the absence of a one-time gain through the selling of 45% interest in US Income Partners 1. So if you exclude these one-time gain, the EBIT would have just fallen around in the single-digit range of around 8% to 9%. At the PATMI level, it was down 50%, and this was because of higher financing costs. So all in all, within the quarter, the story hasn't changed since last quarter when we talked about there was actually turnaround in corner in China. So again, just remind everyone, GLP operates in four core markets. So we're talking about China, the US, Japan, and Brazil. So four of these key markets. And China remains as one of the a very important market for them because 57% of its net asset value, or I mean like of its assets, in other words, are actually from China. So China remains a focal point and is an important market, as I was saying. So operating performance, it continues to remain stable, and we expect it to stay resilient. So within the quarter, they have actually started $294 million of new developments, and these new developments come from the stronger markets in China. So we're talking about the mainly in the second tier cities. So stronger tier markets are first and second tier, but the management has actually mentioned that most of these are started in the second tier cities, and they've been very selective towards the kind of developments that they are doing. Essentially, they're only doing developments with at least an average lease ratio of 89%. So at this point of time, China properties lease ratio is currently standing at 87%. So moving forward, if they continue to maintain a stance like this, you can expect lease ratio to be very stable. So just a bit more on operating performance-wise. In terms of effective rents, it has been stable across the board. It's essentially just like last quarter, and we believe that it's going to stay like this for at least the next 2 or 3 quarters, or at least the rest of the year, in fact. And still on China, uh, we mentioned in the previous report that we are expecting further cap rate compression. So within this quarter, quarter-on-quarter basis, there was an 11 basis points cap rate compression of to 6.3% on its Chinese assets. So we have actually adjusted our forecast. We are expecting at least around 20 to 30% of cap rate compression for at least for the rest of the year. So why is this important is that further cap rate compressions will benefit asset values. And again, quoting my previous report again, I was telling everyone that there's actually a key catalyst to watch for, which is potential monetization of Chinese assets. So just reiterating again, China remains a very important market for them because 57% of its net asset value comes from China. So if they are to monetize its Chinese assets through some form of whether is it a REIT listing or is it like a setting up of more of more income funds, is definitely somewhere for investors to watch for. So the story remains the same. And finally, on the fund management platform, AUM actually slowed down. It grew 7.7% to $37.7 billion, but this is actually the lowest since 2012. Apart from the setting up of a new income fund, which is US Income, the US Income Partners 3, which set up in December 2016 or 2 months ago. This was this represents the smallest investment to date. So in other words, this is the third fund in the US. So we believe that upon setting up of these funds, it is very unlikely for them to consider further expansion in its US portfolio. Meaning to say that we expect them to actually consider other markets, or in other words, mature markets for growth. And the management has also mentioned that Europe is somewhere that they've been looking at, and we believe that they are likely to start looking in that area, although there's no definitive timeline on that. So with that, we've actually downgraded our rating to neutral, upgraded target price to 260. Last trading was $2.76.
Morning, everyone. This is Lindsay, your consumer and healthcare analyst. So just a brief update on Fraser and Neave FNN. So they have announced results last week, and we have been reiterating on our reduced call since we have pick up FNN pick up coverage on FNN. So As mentioned, we maintain reduced rating, but we have upgraded our target price from 170 to 180 due to due to a review on our PR multiples, where we peg it to dairies company, East Asian peers dairy companies, as we have seen that there's a trend that dairies has been the core contributor to its revenue as well as its bottom line. So as you can see from here, that when we have been continually talking about the soft operating environment in its core markets, namely Malaysia, Singapore, and Thailand. So you can see that on its top line, it's actually growing at a flattish figure at 0.2%. And if we look at the overall volume growth for its beverages as well as dairies, they are actually quite soft. As you can see, -1%, and here is +1% on the overall volume growth. So this further reaffirms that our view that the operating environment in these three core markets will remain challenging. Hence, we are still expecting a subdued top line growth and margin compression. So as you can see that from here, the PBIT, the EBIT margin actually fell from 10.9% to 9.4%. This is mainly due to a weaker ringgit, competitive pricing environment, especially in Malaysia, high operating expenses. As you can see that the percentage operating expenses as a percentage of sales actually increased. This is mainly due to the higher marketing as well as distribution expenses. This is actually a typo. This is N. And let me brief you through a bit more about our regarding margin compression. We're expecting it to continue. This is because that due to the higher operating expenses, in particular, their marketing as well as distribution expenses. And due to the intensified competition in Malaysia, we do not expect that F&N would pass on the increased cost to consumer at the moment, as they are trying to retain market share. And thirdly, the increasing raw material costs, particularly in sugar. As you know that Malaysia has actually hiked their sugar prices last year. There's a possibility of a sugar sin tax implementation this year in Malaysia as well. This would further compress EBIT margin if this is to be carried out. This sugar sin tax is actually a tax that government will impose on all, no matter imported or locally produced sugar sweetened beverages. Having said that, we believe that dairies will continue to be the core contributor to its revenue as well as its bottom line, especially dairies Thailand. Why do we segregate out Thailand as well as Malaysia? Because for Malaysia, its main product would be the condensed milk, which its main raw materials would be sugar. So dairies Malaysia would likely to be hit by the higher sugar prices. As for dairies Thailand, it will continue to sustain its revenue, its contribution, driven by the favorable milk-based commodity prices, as well as improvement in operation efficiencies. As you know that they have actually had a new plant in Rojana last year that should be able to improve on their operational efficiency. And another bright spot, the bright spot in FNN's business would be in its new markets, in particularly its Myanmar and Vietnam markets. So we can see that in other markets, its beverages sales actually grew 240% year-on-year, and is mainly driven by Myanmar as well as Vietnam. The strong growth is actually a result of distribution expansion and marketing initiatives and promotions. So we are also expecting that marketing costs will remain elevated as they will reinvest the proceeds back into the new markets for marketing activities. So next, let us look at what actually have changed as they have promised or they have constantly been looking out for M&A opportunities. Although that we are slightly disappointed that they have yet to secure a big acquisition deals yet, but they have actually announced two bite-sized acquisition deals. First of all will be the Penguin Random House business in Malaysia as well as Singapore. So this is mainly to scale up their distribution business. However, it's actually currently under the review of Competition Commission of Singapore to review whether this deal would breach the anti-competitive law in Singapore. But should the deal went through, we still do not expect that there will be a strong earnings turnaround. As you can see that for last year, P&P, that is its printing and publishing business, actually contributed a negative 2.9% of to its EBIT last year. The next deal would be on its additional shares or in Vinamilk. So as of today, its total interest is actually at about 17.5%. That's that we actually view this positively, as it allows FNN to attain greater streams of dividend income. And FNN, the management has actually indicated that they are interested to buy more shares in Vinamilk if opportunities arise. But having said that, as we have mentioned a lot of times, that the sale of stakes in Sabeco as well as Vinamilk is still there's still no concrete timeline out yet. So barring from these two potential re-rating catalysts, we maintain our reduced call, and we have upgraded our target price mainly due to the review of PR multiples. And the last trading price is at $2.11. Next, I will pass on to Kang Wei, who will be updating on US trading note.
Thank you, Linsin. Okay, good afternoon, everybody. This is Kang Wei here, and we'll just be doing a monthly performance review of our trading notes for the US, as well as talking about the latest trading note that we just released on Friday. In case you're unaware, we've started to release our trading notes on the US, which gives trading ideas on what to buy for the US market. It tends to combine both the fundamental as well as technical as much as possible. So for the month of January so far, this is the performance of the 3 trading notes that we've released for the month of January, and how they performed in the month of January itself. So we released on Alibaba with an entry price of $94.91, and the price closing as of last day of January was 101.31 with a target price of 109 and a stop loss of 85.9. Performance so far is about 6.74%. I think the last close as of Friday last weekend was 102.36, so it's still slightly up from there. For Facebook, we actually had an entry price of 124.90, and we actually closed our trade at 130.98. We originally had a target price of 140, but we decided to take our profit at 130.98 with a performance of about 4.87%. And Metatronic, we also opened the position and with an entry price of 75.09. The last traded price was about 76.15, so we are still a little bit above the performance there at 1 point something percent. So since we released our trading note on Alibaba, they actually posted better than expected earnings, as well as Jack Ma having a very positive meeting with President Trump. So all in all, there were a lot of positive signals for Alibaba that caused it to go up. And so fundamentally, we still stick to the thesis that Alibaba is putting in place a lot of infrastructure for it to continue to be very integral to the e-commerce and as well as the whole Internet of Things side in China. And technical views remain unchanged, so we're going to continue sticking with this share and keep our position open for the time being. Continue target price is 109. For Facebook, they did post pretty good earnings recently. However, they did guide that the rest of the year is going to be quite flat, saying that a lot of their ad revenue, etc., is going to be a bit saturated at the moment. And besides that, it looks like their user growth is starting to slow a little bit. So with all of that, and technical wise, we also saw some resistance coming up at that point in time. So we decided to close our position at the 130.98 target price. Sorry for that typo. That was the closing at 31st January, not when we actually took the profit. Since then, it actually has gone up about 134, but we decided to that at this point in time, it's not viable for us with our previous target price to give an re-entry into Facebook at the moment. But if you do have the share, you might want to consider taking profit based on our analysis. For Metatronic, this is a less well-known share, so if you're not familiar with it, you can take a look at our trading note. But on a cursory, what they do is that they are a medical device manufacturer. So they produce research and develop and produce medical devices such as pacemakers, excuse me, the latest one that they're coming to come out is artificial pancreas to help diabetes patients. So when we released the results, I mean the trading note, a few days later, President Trump actually really signed an executive action that called for the U.S. Government bodies to start to scale back on the Affordable Care Act, ACA, or more colloquially known as Obamacare. So that caused the performance of the share to be a little rocky. We did dip a little below our entry price for a few days, but since then there was a potential rumors of a potential deal for them to sell their medical supplies business, which they actually acquired when they acquired a different company, and this is not really their main business. So they're looking to spin off or sell off this medical supplies business, selling things like syringes, etc., that kind of things. That business unit is actually valued at about $5 billion, so it's quite a lot of profit for them to make if they were to sell it off, and that actually caused their share price to go up quite a bit. So the last closing price of 31st January was 76.02. I think the last close as of Friday last weekend was the 76.15. Technical views still remain unchanged. We're still looking at the target price of 84.28, but this one will probably be a little rocky as they continue to have issues in the healthcare in the US. So all in all, the performance you can see in regards to our calls versus the S&P, Dow Jones, and Nasdaq, we're doing for most of our calls doing pretty well so far. So hopefully we'll be able to continue this performance through the rest of the year. So onto that, our latest trading note that was released on Friday is on GNC Holdings. So if you're not familiar with GNC Holdings, they are vitamin and supplement company. If you go around your malls, certain kind of the malls in Singapore, you should be able to see there's this GNC Holdings selling supplements, vitamins, protein shakes, etc., that kind of thing. And the reason for this is mainly a fundamental call rather than a technical call, being that GNC actually was down about 78.8% from their 52-week high to 52-week low this year. So we decided to do an entry at 8.47 with a stop loss at the 52-week low at 7.62 with a target price of $14 per share. The Bloomberg consensus is about 12.06 and the last close as of Friday is 8.52, so we are a little bit up from there. Now, the reason for them falling so drastically is that the revenue has been flat over the past 3 years and is in fact estimated to come down over when they report their next results. They're reporting their results on the 16th of February. So the previous CEO actually stepped down in July last year amid, I think, shareholder complaints that were slowing growth, flat growth, and income dropping. You can see that gap income, they've actually reported a fall of 14.3% in 2015, and there's an expected fall of, analyst consensus expected net income to fall another 22% in this year. But because of the sell-off in price, what happens is that GNC is now trading at about 4 PE ratio with a 9.4% dividend yield. And to me, this 4 PER is a very, very low PE, and that's I think that the share price has come down too much. It's a bit oversold. So, because this company is still making profit, it's not that it's a loss-making company. Their net income for the 9 months of 2016 reported so far was US $147.2 million, with an operating cash flow of $169.75 million. And at that 9.4% dividend yield that I was talking about, that dividend payout ratio is only about 28%. So that's actually a very low dividend payout ratio. And so we feel that this dividend yield is, this dividend that they are paying should be sufficiently covered based on their operating cash flow as well as their net income. So the one thing caveat though is that besides the falling revenue as well as falling income is that they do have a very large amount of debt, US $1.54 billion in debt. Now, the majority of this actually is due in 2019 and at a very low interest rate of 3.75%. That makes it an annual interest expense of US $46 million. So looking back at their net income as well as operating cash flow, you can see that interest-wise, they are more than able to cover this interest. And when it comes time for the refinancing of the debt in 2019, I believe that they should have no issue to refinance their debt again, since they are, more than able to cover this annual interest in payment. Even with falling income, etc., you should it should be able to cover this interest payment sufficiently. Now, as I mentioned, the previous CEO stepped down in July last year, and the new CEO stepped up, and he conducted about a 90-day in-depth research or analysis on their business model, and he came up and very candidly admitted that the business model of GNC in the past was broken, that there was something very wrong with how they were doing business, and he has a brand new idea of how to do a lot of things. And you can see more in the report, that the trading note that we released, but he identified a lot of low-hanging fruits that the company actually can very quickly remedy in order to return to growth or return to profitability. Certain things such as the fact that they had very poor inventory management in the past, causing a lot of their products to be out of stock when clients wanted it. So that caused clients to stop coming back, because if I come, the product that I want is out of stock, or they don't have it, they can't tell me when they have it. So the CEO appointed a new inventory manager, and so things like that, where it's very low-hanging fruit, very easy for them to remedy and hopefully turn back to profit. Besides that, he released a new business plan that he terms the new GNC, and that calls for the lowering of their product costs, as well as introducing new products, as well as a new loyalty program, as well as new technologies to improve the shopping experience for GNC customers. So new technologies such as a mobile app in order to engage customers, tracking what kind of products that they want, probably like how long the product, the amount of vitamins is, and sending reminders, do you want to top up your order for delivery again, etc., etc. So all in all, we believe that at the current price, with this 78% to 80% drop in share price, has caused GNC to go into the oversold territory, and that they are being priced for failure at the moment, even though they actually are still profitable. They're still generating quite a bit of operating cash flow. And if you were to look at their closest competitor, Vitamin Shop Inc., they actually that company actually trades at a 12.5 PE ratio. Now, I'm not saying that GNC deserves to trade at a 12.5 PE ratio. They are still suffering problems. Let's not sugarcoat it. They are still suffering problems. They are still falling in terms of revenue as well as profit. But at the current P ratio that they're trading, this is a bit ridiculous. It's 4 P ratio and 9.4% dividend yield. And so we believe that the downside, if you were to at our stop loss, which is the 52-week low, is there's very little downside, or rather the downside is not too far from the current target, from the current entry price. But if GNC were to show signs of a turnaround when it comes again 16th of February, if they were to show signs of turnaround or even stabilization, you can potentially see a PE expansion, maybe not to 12.5, but maybe if you can see a PE expansion of even double to 8, 8 PE is not that hard to achieve. And that is essentially almost a doubling of price. Even if you account for the falling income, that's you still see, instead of 8 going to 16. That's why we have the target price of 14. So keep an eye out for the 16th of February, which is the Thursday for US, which is our Friday Singapore. And if they do show signs of this recovery for the business, if the CEO's new plan starts to get traction, you might start to see that the market might start to view GNC a little more favorably, and then you can benefit a bit from the potential P expansion. So again, we reiterate that our entry price was about 8.47. The last closing price was 8.52, and with a stop loss of 7.62 and a target price of 14. So with that, that's the trading note done for the US, and that's the webinar for today done. If there's any questions, do drop us questions, and we will do our best to try and answer them. Thank you. Oh yes, and please remember to do the survey. You give me a second, let me copy the link again so that we can put it in. Okay, you can see the link again in the chat box. Do help us do the survey so that we can better tune our webinars to suit your needs. Thank you. Okay, the slides will be, you can get the slides actually yourselves from the link that you can see on the page on this slide now, the www.programs.com.sg/education/webinars. They will be available for download there once we've uploaded the slides. Thank you.
Hi, this is Richard speaking. Yes, there's a question. about whether the growth in rail business can offset the pressure in taxi business. Actually, that's quite hard to say now, but it should mitigate it. Anyway, in the most recent most recent FY, actually the Singapore taxi business, the revenue actually was higher. One of the reasons why it was higher, even though there were less trips, is because of the fleet renewal to the I-40. So because it's new taxis, that's why they're charging a higher rental rate, and that's why the revenue was higher last year. So, but then, as I said, they are now going to try to extend the lifespan of their older taxis to 8 years, and so there might be some impact on the revenue on that side. So it's hard to say how much actually will the pressure be. Yes, the rental will be lower, but there are other mitigating factors, as mentioned just now about the new taxi. This year they are going to slow down on the taxi renewal as well, but there will still be renewal of the fleet. So at this point in time, it's hard to say whether the rail business will completely offset or not. So so it's hard to say, but yes, the rail business will have some offsetting effect. There's another question on REITs. So what is the take on REITs at the moment? So actually for REITs, we actually have underweight rating for the sector. You can look at last week's webinar where we spoke extensively on the REIT sector. Yeah, and if you don't have the slides, you can come to the link on the page right now to watch that video and get the slides for last week's webinar as well.
Okay, since there's no further questions, we'll end this webinar now. Thank you for your participation, and we'll see you guys next week.